So let me begin with the earning per share, what we commonly known as the EPS, which is guided by International Accounting Standard number 33. So under that standard, when you read IAS 33, that is where you will find all the things to do with earning per share, both basic and what we call the diluted EPS. So under this session, there is a discussion of defining what is an EPS, what are the potential ordinary shares, and how do you compute the EPS, and how do you compute the EPS if the potentially ordinary shares are dilutive, which will not make the EPS to go down. So it is a requirement for all public companies to, in their financial report, to include the earning per share. So as you publish your financial statement, you have to indicate the earning per share, both basic and diluted EPS. So basically, when we talk of EPS, this is the amount of earning or the profit for the period that is attributable to each ordinary share or equity share. For instance, we have the profit that you make from the financial statement. You'll find that the profit that you don't distribute all of it. So that is where we have these two items where people confuse. We have what we call the earning per share and the dividend per share. This earning per share is what is supposed to be attributable to the ordinary shareholders. So you might find maybe this is 10. Since you not be able to distribute all your profits to the shareholders as dividend, because from your financial management, you know, we have different scholars who argue for and who argue against dividend, where we have both relevant and irrelevant theories. So out of the profit that you make, you need to retain some amount of money to be used for the either expansion business or other operation. So you might find here maybe they are paying 8%. Then there is something else that we call the dividend out ratio, which now will be the EX divided by the ES. So this will now give you 50%. So 50% implies that out of the attributable profit shareholders, it is only 50% that has been paid as dividend, rest has been retained in the organization as retained. But where you find the EPS and the DPS, we have the EPS and the DPS, then we talk of 100% dividend payout ratio. It simply means everything was paid as everything that was attributable was paid as dividend during that particular financial year. So I'm sure now you have a distinction between the EPS and the DPS.
Sure.
EPS is what is supposed to be paid, but EPS is actually what was paid, and there is a difference. And if there's no difference, then the dividend payout ratio will be equal to 100%. So we have said the earning per share. We also talk of what we call the potential ordinary shares. So there's some things which are not ordinary shares now, but they have a chance, or in future, they can be converted into ordinary shares. And we have given examples of the potential ordinary shares where we have said we have the debt or equity instrument. For example, we have what we call a convertible debenture. So if that debenture has a potential of being converted into ordinary shares in future, then that is considered to be a potential ordinary share. It will make the outstanding number of ordinary shares to increase. Then we also have the share warrants and options. And what we mean by a warrant is a stock that represents the right to the purchase a company's stock at a specific price at a specific date in future. Then a warrant is issued directly by a company, an investor. And these are purchased when it is believed the price of the stock will go up or will go down. It is something kind of speculation. So depending with yes, speculation.
Okay.
So it simply means there is a chance maybe in the future, if the price goes down, you can be able to buy those options. It's the same way we have the issue of hedging for the oil prices. So even in shares, we have what we call the warrants and the options. A price is reserved, then in future, if the price goes down, you can now be able to buy that particular price. So there is a potential ordinary share. So that will make the ordinary shares to be able to increase. Then we have what we call the employee plans, and from your financial management, again, because of the conflict, sometimes employees will be given the option of having shares so that they have that ownership of the organization. So these shares, which are the employees, in future, if the employees have been given, then they will also increase the number of outstanding ordinary shares. Then we have other shares which are contractual, whereby maybe you have a certain condition, maybe that will arise because of purchase or a business or another asset in future. So if you trade maybe a particular asset with shares, then your shares are also likely to increase. So all those four things that I've mentioned, then it simply means that is what we mean by potential ordinary shares. Potential ordinary shares means in the near future, they have a chance of being converted into outstanding ordinary shares, which we use in the computation. But in terms of reporting, you are supposed to include the earning per share without qualifying whether it is a basic or whether it is diluted. What we mean diluted, for example, I want to distinguish between the two terms, both basic and diluted. For example, today, assuming now we are in, let's assume this is 2019.
Yes.
During the year 2019, the amount of profit attributable to the ordinary shares, 16, maybe let's talk 16,000. And the number of outstanding ordinary shares, 8,000. Then during the year 2019, 2020, you make a profit maybe of 10,000, and because of the potential shares which can be converted, you find now your outstanding ordinary shares are 18,000. Now you are taught to compute the EPS. You'll find that the EPS for the year 2019 will be the attributable profit 16,000 divided by the outstanding ordinary shares, give you an EPS of 2 shillings. Right?
Yes, 2.
Yeah. Then 2020 EPS will be 18 divided by 18,000 ordinary shares outstanding. This will give you an EPS 1 shilling per share. So as now this was for the same financial year. This was the same financial year. You will find that during this particular period, your basic EPS will be 2. Because of the potential ordinary share, will reduce what you're supposed to get. Diluted EPS will be 1. For example, when you are consolidating, you might acquire some shares of another company. when you consolidate and you acquire shares of another company, you will find that the number of outstanding shares will increase. So that will also make your EPS to reduce. So it means that purchase of shares in that particular company, it's making your EPS to be diluted because the owners of the business will get they will have an attributable which is less than the basic. So that is the difference between the basic and the EPS.
Mm-hmm.
But in terms of report, you just give the two figure EPS, then the other EPS one. So people will now be able to see the shares that you acquired during that year were diluted because they reduced what is attributable.
DPS.
Yes,
That means they have been neutralized, all of them, that in 100%.
100%. So the dividend payout ratio is 100%. They have not retained anything.
Mm-hmm.
Yes.
And is there a time like that in most cases?
Or in organizations, for example, for the public listed companies, that rarely happens. But for the
Mm-hmm.
smaller companies,
Mm-hmm.
because sometimes they want to entice the shareholders and the profit is not much, you might find
Yes.
that happening for the private companies.
Okay.
Yes, now for the private companies, they still have options of inviting another director to come in with new shares.
Sure,
But for
sure.
the bigger companies, that rarely happens. It is even better if they don't pay any dividends.
Okay.
Like for instance, when Uchumi was experiencing financial problems, they were
Uh-huh.
not paying dividends because it was not possible because they were making losses.
Okay.
So in that case, if you are making losses, what you
Mm-hmm.
compute is it's a negative EPS. We usually call it a negative EPS,
A
but it's
negative.